Hello, 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 everybody. Welcome to our tax strategy series, where today we're going to be tackling a topic many entrepreneurs find challenging: managing taxes when you own multiple businesses. So, whether you're juggling a consulting firm, a startup, a side hustle, or a combination of ventures, understanding how to navigate your tax obligation efficiently is going to be important for you. So, before we get into our topic, let me introduce myself. So, my name is Shane Harris, and around here on these social media streets, I'm also referred to as Shane the Negotiator, and I help coaches, consultants, and service providers who are overwhelmed and lack guidance to achieve true financial freedom. And I do that by providing expert tax and coaching services. That is what I do. That is who I help. So let's get into multiple businesses, one owner, tax management strategies. So many of you have multiple businesses. I know myself. I have several businesses that I own. Some are corporations, some are LLCs, some are sole proprietors, some is a little something, something, something on the side. You know what I mean? Nah, you don't know what I mean. Nothing illegal. And some of you may fall into that category as well, as oftentimes as you coaches and consultants and service-based businesses in general, not to saying that product-based business isn't the same, but I'm mainly talking to you guys. We tend to want to have multiple streams of income because to today's age, without multiple streams of income, things can get a little bit tight. So having that multiple streams of income, even if it's not about making it tight, because sometimes we're comfortable, but we want to have that additional stream of income because why rely on one when you can have multiple? But having those multiple streams of income comes with great responsibilities, even though it also comes with great rewards. And other times it can also come with great headaches. So that's why I am here with you today so that we can talk about what multiple streams of income can mean for you and your business and anything surrounding your taxes. And Kayla, can you please stop shaking on my live? Sit, please. Sit. Pardon me, because my dog is trying to show out right about now. So I had to tell her to cut it out. All right. So now that she's down, we're going to continue. So the complexity of multiple businesses. So owning multiple businesses can complicate your tax situation, as if taxes is not complicated enough, right? So each business type, whether it be an LLC, S Corp, C Corp, sole proprietor, or a partnership, carries its own tax implications. The key is to optimize your overall tax burden while ensuring compliance across all the ventures. So let's talk about organization and separation. So, first and foremost, you want to keep those finances of each business separate. And I can't stress this enough. We talk about documentation, we talk about not commingling funds. Now we have multiple streams of income, multiple businesses. You definitely don't want to mix business A's income with business B and business B with C and everybody else. Okay. So this means separate bank accounts, separate accounting records. Mixing transactions can not only create a nightmare for your bookkeeping, also raise red flags with you know who, Uncle Sam. So let's do a quick case study. So let's talk about Elena's entrepreneurial journey. So Elena owns a graphic design LLC and a coffee shop operated as a sole proprietor. So by maintaining distinct financial records for each business, she was able to clearly report her income and expenses for each venture, taking advantage of specific deductions available to each business type. So before we move on, let's talk a little bit about these different business types. So let's this particular business owner, which has the coffee shop and a graphic design LLC. So one is a sole proprietor, one is an LLC. Oftentimes, you may not have LLCs, you may be sole proprietors, but you have multiple sole proprietor businesses. So as a sole proprietor, a quick recap, you can have an EIN, or you can use your social, either one. I recommend your EIN if you're not using it. But as a sole proprietor, you can have 5 businesses, and all 5 of those businesses will use the same EIN. Okay. And I apologize for my phone keep blinking. It's tax season, so I just can't shut my phone off completely, even if I'm doing a recording or I'm doing a live. So bear with me. It keeps blinking off text messages and things like that. So forgive me for that. So as I was saying, you have multiple businesses. So we have like 5 sole proprietor businesses. They're all going to use the same EIN. So oftentimes the mistake that I see you guys are making, you're like, well, it's all using the same EIN, or I'm using my social for all of these businesses. So therefore they can all go in the same pot. We can shake it up and we can mix things up, and that's okay. Wrong, wrong, wrong. They're still separate individual businesses. So for instance, I was doing Turo. I'm no longer doing Turo, but I am still doing Airbnb. So my Turo business and my Airbnb business in 2022 and half of 2023, when I was still doing Turo, I must consider a sole proprietor. So I use an EIN number for both, the exact same EIN number for both businesses. They each have their own QuickBooks account for the accounting. So Turo has its own books. Airbnb has its own books. Turo has its own bank accounts. Airbnb has their own bank accounts. The two shall never meet. Okay. Now, sometimes you as entrepreneurs, you may run into a financial pinch and you may want to borrow from Peter to pay Paul. And you do what you're going to do. But I'm here to tell you, if you're going to borrow money from one business to the next, you have to do it the correct way. And I'm not here to go into details on how you necessarily do that, but there's ways in which you can borrow from one business to put into another business without necessarily mixing up the funds. Okay. So let's go on to LLCs. So similarly to the sole proprietors, LLCs, now it's a disregarded entity. You got a little bit more respect on your name with the LLCs. And I'm being, silly. They're both, good businesses, but you know what I mean? You still would need to have multiple different LLCs. If you have multiple LLCs, you will still have to have multiple bank accounts for each one. So LLC 1 will have its own business bank account and its own books. LLC 2, own business bank account and books. LLC 3, the same. Okay. You should not be mixing them up. So you're not going to take funds from LLC 1 and use it to make purchases for LLC 3. Now, if you want to borrow money from one to the other, again, there's ways in which you can do that. They're all separate businesses and they should be running independently of each other. So let's now upgrade. We're going up the elevator to the corps. So now we have the S Corp, and of course we have the C Corp, where it's a little bit more that goes into this. Now you can't be playing around. You kind of get away with a little bit of slap on the wrist if you have that sole proprietor as using your EIN or your social. You get a little bit harder slap on the wrist if you have that LLC, but you're gonna get punched in the face if you have that corporation and you mixing things up. And of course, we're going to throw in the partnerships in the mix of this also. Okay. So as you go up in the different entity types and the levels, the more complex things get, the more compliances are needed. So you don't want to be messing up things. And oftentimes, many of you are watching me right now. You're going to watch the replay at a later time. It's going to be years from now. And you're making these mistakes because you think, well, I own all of these business. I'm the owner of every single one of these. So I can do what I want. Wrong, wrong, wrong. You can do what you want in terms of you are in control and direction on which you take your business. But you can't necessarily do just what you want when it comes to the financial side of things, because you're going to end up hurting yourself. Either you're going to owe a lot of taxes, you're not going to pay enough taxes, or you're going to be in some other compliance issues when it comes to the federal and state regulations. Okay. So that's just a quick synapse of what I mean when I'm talking about these different entity types, because each one means something different. And because you're the sole owner, you think that you can do what you want, and it does not work that way. You will be in trouble. And it's oftentimes, many of you probably already got bitten by the IRS letter, and you're like, uh-oh, I'm in big trouble, Shane. I need some help. Come on through. I got you. We hook you up for a small fee. Sometimes it's for a large fee because you didn't do the right things the first time. You didn't listen to myself, and some other people might be out here educating you and giving you all this information. You do what you want anyway because somebody over there on another platform said, oh, you can do this. But even though they may be correct that you can do this particular thing, you may have to do something else before you get to do that thing, but you guys don't know that because you just ran with the first thing you heard. So that's why I'm here to debunk a lot of these misinformation out there, educate you with the right things so that you can make the right decisions and the right choices for your business and you can stay out of IRS hot water, okay? So utilizing losses strategically. Let's go on now, then I'll get off my soapbox on that. So if one business suffer a loss, which oftentimes it happened, those losses can sometimes offset the income from the other businesses. That's a nice little incentive, reducing your overall taxable income. However, there's always a but. Be aware of the IRS rules regarding passive activity losses and, of course, those hobby losses. There are some limitations and things like that when you have losses. And of course, when it comes to those hobby losses, if it's a hobby, it's a little bit different than if it's a business that you're trying to make a profit for. So you have to be careful with that. So as I said, multiple streams of income, multiple businesses, one owner is not necessarily a bad thing. It can be a great thing, but it also comes with great responsibilities and compliances that you may or may not be aware of. And that's why I'm here to tell you about them. So tax filing considerations. So depending on your business structure, you might file a separate tax return for each entity or a combined return if they are structured as a disregarded entities. So consulting with a tax professional, you can come on over and see me to determine the most advantageous filing strategy for your situation. So you may have a sole proprietor, you may have those multiple businesses as a sole proprietor. They will file, when you file your taxes, your 1040 individual taxes, you will file each one of those businesses will be filed on a Schedule C of its own. So as I said, I have my Toro business. Toro has one Schedule C. Airbnb has another Schedule C. And if you may have a 3, 4, and 5 other types of sole proprietor businesses, they each get their own Schedule C. Now, the price when it comes to filing your taxes, it's going to jack your pricing up a little bit. However, pay the cost to be the boss, okay? You want to have multiple streams of income, it comes with a price. So that's why you got to be really careful out there when you guys having these pop-up businesses. I'm going to do this and I'm going to do that. I'm going to do lashes over here. I'm going to be nails over there. You got all these multiple businesses and these side hustles. And I'm not trying to say don't do it, but it comes with responsibilities as well. So each one of your sole proprietor, and even if you upgraded a little bit, you went up the elevator to the second floor and you got that LLC, the LLC is going to be filed on your personal taxes with your 1040 tax filing. You're also going to use that Schedule C. So whether you're a sole proprietor using your EIN or a social, or you have that LLC, the profit and loss, that Schedule C, you're going to file all your businesses on one each. Each business, one Schedule C per, okay? So then, of course, some businesses, you have 2 tax returns you have to file. You have your personal taxes, which, as I said, sole proprietor LLCs, you file your personal taxes and your business taxes together on that 1040 with the Schedule C. Now, if you have a partnership, S corporation, C corporation, those are separate business tax returns, okay? So you may have a partnership with your spouse or your friend or your neighbor or some stranger that you met down the street somewhere, and you guys talked about a topic and you're like, oh, wow, I wanted to do that. And they're like, oh, I wanted to do that too. Let's form a business together. I hope not, but stuff happens. I get it. I know how you guys operate sometimes. You may have that partnership. The partnership needs to file a tax return on that Form 1065, and each partner is going to receive those K1s. Go back and watch the previous video where I just talked about those Schedule K1s, and I went into details talking to you about what goes on the K1 and what it means by having each one. They get passed on to you to file your personal taxes. So I'm not going to get into that too much right now. Go back on that 2024's playlist and watch the K1s and watch those business tax returns that if I haven't spoken about it yet, it's going to be coming up at some point in time in the future, okay? So the 1065 is going to be for the partnership. The 1120 is going to be for the C corporations. And of course, the 1120S is going to be for the S corporation. So those are three different business tax returns you're going to file. So somebody may have a partnership. Somebody may also have an S corporation. You also may have a C corporation. Then you may have an LLC. Then you may have be operating as a sole proprietor. So that's 5 different types of businesses on different entity levels that requires different things. So if you are filing your own taxes, first of all, if you try to file your own taxes to have a partnership or S corp or C corp, it's not happening. That's not going to happen because you're not going to be able to have the software to do so. So you have to seek with a professional. But some of you don't listen and you try to, I'll file my business taxes, my S corporation on a Schedule C. Nope, that is not how that works. Don't do that. Don't mess yourself up any further. Stop what you're doing right now. Come see me or go see somebody else that's reputable that's going to be able to help you. And go back in that 2024 playlist and look at where we spoke about how to select your tax professionals and the questions that you can ask. I went in there to show you how you can look up tax preparer to see if they are credentialed or not. So go on over there in that playlist. It has nice little things in there for you that you can go and rewatch, so that you can get educated on things to move forward. All right. So enough about that. So I said you may have the business tax return, and then you still have to take those K1s that you're going to get from the business and take it over and file your personal taxes. So it's 2 different types of tax returns that you're going to have, but you may have multiple businesses on those tax returns. So we want to be mindful of that. Now, let's talk about leveraging retirement plans. So last year, I did speak about retirement plans in the Pathway to Mastery playlist. So go back and watch the little snippets and things that I spoke about when it comes to retirement plans. So we're just going to touch on it teensy binsy wit. I'm not going into too much details on it. So consider setting up retirement plans for your businesses. You hear that? Businesses with an S on the end, because it's multiple businesses. You can have retirement plans set up for each one of them because it's all operating independently. Not only can this provide you with a nice little nest egg, but contributions can also reduce your taxable income. Less taxable income, less taxes you have to pay. So there are various plans that you can choose from, some of which are like a SEP IRA, the simple IRA, a solo 401k, etc. So each with its own benefits, and of course the contribution limits is going to be different for each one of them. So huge tax savings on that. So advanced tax planning strategies. Again, last year on that Pathway to Mastery playlist, we talked about tax strategies, tax planning, and I spoke a little bit about it on the 2023 playlist as well. However, I'm going to just touch on it a little bit here. So go back and catch those previous playlists and look at the tax planning strategies to get more details on it. So incorporate advanced tax planning strategies such as income shifting, where legally permissible, and utilizing tax credits available to one business to offset the obligations on another. Always ensure these strategies are implemented under the guidance of a tax professional to remain within your legal boundaries. So Ted, your income from one business can help to offset the income from another. Remember, they're separate businesses. They're doing their own thing. You're not mixing and mingle. But when you file your taxes, remember, you're the owner, so everything is coming back to you at some point in time. And you file your taxes, you have these multiple incomes. So let's just say my Toro business it was terrible. And I lost a lot of money. And I'm in a negative $20,000. My profit, my net, I'm at a loss, $20,000. So my Airbnb business, let's just say, is popping. And I'm in the positive of $20,000. So separately, a $20,000 profits for my Airbnb business. Oh, I'm going to owe taxes on $20,000. Okay. So let's do the math on that. So $20,000 is my profits for my Airbnb business, and I have my nice little calculator out here for 20,000. So I'm going to do 15.3% for our taxes. So the taxes for that is $3,060 on that 20,000. The self-employment taxes, that is, that I may have to pay for that. Of course, half of this is going to be deductible, so it's going to bring it down by half. So it's going to be roughly like $1,600, close to $1,600 in taxes is what I'm really gonna have to pay. But $3,060 on $20,000. So Airbnb, I mean not Airbnb, Turo has the loss. It's a negative. So if it's negative, there's no taxes to pay on a negative number. You're not profitable. You didn't make any money. Of course, there's going to be limitations on the passive activity loss and things like that, which we talked briefly earlier. I mentioned it. That's another live for a different day. So now this $3,000 in taxes, I'm not going to have to pay because Turo is going to offset. Airbnb is going to Turo is going to, the negative is going to offset what I have for Airbnb. So negative 20 plus positive 20, you already know, put it together, it cancels each other out, and it's now my net is going to be zero. All right. In terms of the IRS, I have a zero because if I have a loss over here and a gain over here, the loss, you're going to subtract it from the gain, and then whatever's remaining is either going to be a positive number or a negative number. In this case, it's zero. It's neither positive or negative. It's neutral. I made zero on paper. I didn't make any money this year because my businesses canceled each other out. So that's one example. You may have several examples like that. I know I have clients that we have several examples of that and combinations of it. So as you can see, tax planning strategies can help offset your income. So if we go back up to a little bit when I mentioned the retirement, let's just say now we had the 20,000 loss in Turo. Airbnb had the 20,000 in the positive, and then Profit First Taxes has 50,000 in the positive. So that's 50 plus the 20 from the Airbnb. That's 70,000. So that 20,000 is only going to offset 20,000 from the Turo. So now we still have 50,000 that Profit First Taxes essentially has to pay taxes on. Now, I say if Profit First Taxes was an LLC and not a corporation. So now I got $50,000 I got to pay taxes on. I don't want to do that. So if I have a SEP retirement plan, like a SEP, a 401 solo 401k or something of the sort, now I can say, well, you know what? I'm going to put 30,000 into my SEP plan as a catch-up contribution before it's time to file these taxes so that I can reduce my taxes. So I might go ahead and drop 30,000 into my SEP plan. So now I'm only going to be taxed on 20,000. So you see, we just did tax planning in less than 2 minutes. So that's an example of tax planning and tax strategies. And that's why you should not do these things yourself. Come to the professionals. Come see me, Shane the Negotiator. Gonna hook you up. So let's do another case study. I like these case studies. So let's talk about Marcus Tech Ventures. So Marcus, who runs a tax consultancy S Corp, and he has a mobile app. Everybody on the app kick these days. I didn't quite get into it as yet, maybe sometime in the future. So he has a mobile app development LLC. So he uses income from his consultancy to invest in R&D for his app. Now, remember, R&D is research and development. And if you go back and watch the playlist from last year where I talked about R&D credits, you're going to get some insights on what that means. So again, he uses the income from the consultancy to invest in research and development for his app. So by carefully planning his tax strategy, he maximizes his R&D tax credit for his LLC, which helps to offset the taxable income of his more profitable consultancy. So let's conclude this on up because we're already getting close to 25 minutes, and I try not to make it too long because I don't want to complicate things and I don't want to overwhelm you guys. So I try not to make it too long. Sometimes we go into about 45 minutes because I'm demonstrating, but if it's not a demonstration, I try to keep it 25 minutes tops, maximum 30 minutes, and rarely do I even get to that. So managing taxes with multiple businesses require careful planning and organization. By understanding the unique opportunities and challenges for each business entity, you can develop strategies to maximize your tax liabilities while fueling growth across your ventures. So let's talk about some teasers. Y'all come on in close. Let's talk about the teasers. So up next, we're going to be talking about high income earners and tax strategies to pay the least in taxes. Now, I know you guys want to hear about this because I do have many of you that are high income earners. High income earners, you up there making $350K or more. That's considered high income earners. We'll explore how individuals with substantial income from various sources can navigate these tax plannings to optimize their and your tax liabilities. So stay tuned for that one, okay? So in closing, thank you for joining us in today's session. If you find these strategies helpful, don't hesitate to like, share, and subscribe and share this video. Your path to tax efficiency as a multiple business owner starts right here, right now, okay? So I will see you on the next one. And until I come back, have a